Hi, everybody. I wanted to give you an overview of the income statement. Remember that we've got four financial statements that are accepted in the United States: balance sheet, income statement, statement of changes in equity, and the cash flow statement. Well, remember that the income statement shows us revenues and expenses over a period of time. The key is the period of time, and what period of time are we talking about? It could be day, week, month, quarter, year to date, for whole year. What period of time are we talking about? And sometimes that's significant because think about retail where they possibly make most of their uh, money and net income in the holiday season. So if you and I were looking at retail income statement for uh, January through uh, say September, we might write off retail. But if we look at it for the whole year that includes the holiday season, we could say, okay, that's worth looking into. So the period of time is very important. Let's look at a couple of things. The first section is revenues. Revenues is what you earn in the ongoing business. You take your sales minus your sales returns and allowances minus your sales discounts and get your net sales. If you're going to do a income statement where you start taking percentages, you're going to use that net sales figure as your 100% and start calculating your expenses off that number, the net sales. If you sell a product, you've got a cost of goods sold section. If you're only selling a service, if you're a dentist, an architect, an attorney, you're not going to have probably not going to have a cost of sold section. If you're selling your time as a professional, you're not going to have a product, so you're not going to have the cost of goods sold. Most of the income statements you're going to look at, though, are going to be selling some kind of stuff, and we have to account for the stuff that we sell. And we do that through the cost of goods sold section to show beginning inventory plus purchases gives us what we have for sale. And for what we have to sell, right now, let's don't worry about losses or anything, or thefts or disappearances or whatever. So we take the beginning inventory plus purchases, and that gives us what we have to sell. And there are two things that can happen to the inventory that we have to sell. It either gets sold or it's still here. So that's what we do. We subtract out what's still here, the ending inventory, and that gives us the cost of what got sold. So from the net sales, we subtract the cost of goods sold, and that gives us our gross profit or gross margin. Okay. We need to make a profit on what we sell because now we've got to cover some other expenses. We've got to cover period expenses, occupancy, insurance, uh, different expenses of the period that are not tied to a specific product, because if they're tied to a specific product, odds are they're going to be up there in cost of goods sold section. These are the period expenses that are mainly going to happen regardless of what we sell. And so we're going to subtract out under expenses, we're going to subtract out the selling and general administrative expenses, and then other period expenses. Subtract that from the gross profit, and we're going to get the proverbial bottom line, the gross margin or gross profit minus our period expenses is going to give us either net income, net loss, or a break even. So I want to talk about that real quick. And there are plenty of people who just want to say, what's the bottom line? Okay, if revenues were greater than expenses, we're going to make a net profit or net income. That's going to be a positive number, net profit. If we lost money where expenses are greater than revenues, we had a net loss. Or we might have a situation where revenues uh, equal expenses, and that's a break even. You know, in the for-profit sector, you know, you really don't see break even that often. I generally see net profit or net loss. But you know, if you're in a nonprofit situation, maybe you've got a grant and you know your nonprofit is been given this grant money and with the instructions, you need to spend this grant. What are you shooting for? You're shooting for break even, because if you have a quote net income unquote where your expenses were less than your revenues were less than the grant, you know you didn't spend all the money in the grant. You probably have to send it back. Or you don't want to have a net loss where you spent more than your grant. That means that took some of your money to administer the grant, even though sometimes that happens. So if you're in a nonprofit situation, you're probably shooting for break even. I got this grant, let's spend the grant. And so, you know, you shoot for break even. Some other considerations that we will get into, like I say, your income statement can be as simple or as complicated as it needs to be. Uh, One of the things we need to look at is cash basis versus accrual basis. With the accrual basis of accounting, remember the matching principle. We're trying to match income and expenses to get the best possible net income figure for those who are looking at our financial statements. When you see a cash basis income statement, and sometimes it's listed not as income statement, it's listed as a statement of cash receipts and disbursements. You don't try to do any matching. You just think checkbook. Hey, the cash came in. This is how I spent it. That's a cash basis income statement. You can get into some specialty construction income statements with completed contract versus percentage of completion. We know to look at product costs versus period costs. That makes a difference. Format, single step versus multiple step. Just remember, multiple step shows detail. Single step is the less detailed summary of your income statement. Then you can get into discontinued operations, extraordinary items. We've talked before about other comprehensive income. And we said, you know, again, oh, I've got that on there twice, product costs versus period costs. Had that on my mind. So again, the income statement can be as simple or as complicated as you need it to be. Like I said, but if you're like department manager, basically you're going to be looking at, hey, here's the money coming in, here's the money going out, and where did the money come from? What did I spend it on? And the proverbial bottom line there is, uh, did I earn more revenues than I spent, or did I spend more than I made? So this is a quick look at an income statement, and I hope it helps. See you next time.